I mean, they're basically saying that, initiating here, Tesla stands out above all the picks in the auto space, which is kind of a big call, I think, from their point of view. Talking about how there's two clocks, a two-clock framework, right? So there's the first clock, which is the near term, that's cyclical, the economy, spending on inventory and cars and parts, things like that. And then the far term, which is secular changes, the big transformation in EVs, the huge sort of rollout, how much it's going to cost, how the society changes, right? So Dan Levy, the analyst there, says that Tesla is well positioned in both worlds, right? From a cash point of view, they have a huge cash war chest that they built up over the years. They're able to spend on their new cars there. And then also from a long-term kind of their EV and software prowess, they have sort of the ability to, they're the only company that has been mass-produced EVs, right? Like on a huge scale. And they have the sort of the software kind of backbone that they've been developing for many years. So those are two kind of bull cases for Tesla right here, right now.
Tesla is still the top-selling electric vehicle brand globally, although its dominance is eroding as rivals offer a growing number of means to get affordable models. While many believe that there is no demand issue for Tesla, it is important to consider that there could be higher interest rates. The economy may go through a recession, and things may get even uglier in China than they were last year. However, although these problems exist, Tesla is not just struggling by itself alone. All other automakers are feeling the heat, and every one of them is hurting just as much as Tesla is. Some analysts have speculated that due to Tesla's high margins, they may continue to cut prices until demand improves. Is that likely? Let's find out. Hey everyone, and welcome back to Tesla Tomorrow. Bernstein analyst Tony Sacconaghi has said that Tesla may indeed have a demand problem. According to the stock analyst, Tesla actually has recent price cuts which are proof that the automaker may not be getting enough demand for its cars. According to TipRanks, Tony is a 5-star analysis with an average return of 13.7% and a 62.99% success rate. He covers the technology sector, focusing on stocks like Apple, HP Enterprise, and Dell Technologies. Tesla bull Gary Black has also described Tony as a number one analysis for Apple, so he may have some very crucial points to share with Tesla investors. In 2022, the Bernstein analysis raised his Tesla price target by 50%, but recently Tony has maintained a sell rating on Tesla and set a price target of $150. According to him, he's not sure that Tesla's demand is really strong, considering that the car company cut prices materially in January up to 20%, especially at a time when rising competition is a problem for car companies. According to a report by the S&P, Tesla's position is changing as new and more affordable options arrive, offering equal or better technology and production build. The report stated that since consumer choice and consumer interest in EVs is growing, Tesla's ability to remain dominant in the market and have a dominant market share will be a challenge going forward. Tesla lowered the prices of its cars in order to increase demand, and while this would have a significant effect on the company's profit margin, Tesla still benefited from the price cuts in a way. Customers reacted to these very huge price cuts positively, and seasonal growth was pretty much in line with expected results. However, some analysts believe that Tesla will need to lower prices even more this year to hit volume targets and stay ahead of the competition. How have these price cuts affected other car companies? Let's find out, but before we do, if you like this type of content, hit the like button and subscribe to our channel, and turn on notifications to keep up to date on everything going on with Tesla. Tesla's recent price cuts have affected a whole lot of car makers, and these companies don't want to lower prices because that would destroy residual values of their cars. A lot of these companies have huge financing divisions and cannot lower prices since it is too difficult for them, but Tesla does not need to worry about that. Tesla is still a new manufacturer, and each year it produces many more cars and expands its markets. Looking at the lead times for vehicles other than the Model Y in the US, customers can get a Tesla within 2 to 4 weeks anywhere in the world, and so there isn't much of a backlog, not nearly as much as many people believe. However, Tesla's demand may not be as strong as it used to be, which is why the automaker needs to release its next generation vehicle. Tesla needs to get a cheaper vehicle out, especially in China, probably because that will be a way to stimulate the demand for Tesla. Musk himself teased at a Morgan Stanley conference that there's a clear path to a smaller vehicle that is half the production cost of the Model 3, which is already Tesla's cheapest vehicle with a starting price of around $43,000. According to reports, there are around 150 new EVs launching in China alone this year, and so Tesla will likely have to lower prices to make sure it hits volume targets. In the long term, it's expected that Tesla will keep dropping prices as it finds new ways to lower the costs. There are still about 100,000 cars in the inventory right now, and so it doesn't seem like demand is fantastic at the moment, and there is the possibility that through the year there will be more and more competition. Some auto analysts argue that the competitions are not going to back off, and it is the conflict between the ICE and EV businesses that's going to create some really tough choices for legacy automakers. But ultimately, at the end of the day, companies are being valued by their performance and future of electric vehicles. For instance, Ford has said that it will produce 2 million EVs by 2026, and they already lost $2 billion in electric vehicles this year, even though they made more than $10 billion in operating profit in their ICE business. For many legacy automakers, they have a pretty robust cash flow, and that comes from their legacy businesses. But the question is, how long can these legacy automakers keep making money from gas-powered vehicles? Because Tesla is growing in production very fast, and that puts more pressure on the whole market, including gas-powered vehicles. BYD is growing incredibly fast in China, and that's where a lot of profit comes from, for most of these legacy automakers. Therefore, if Tesla drops prices even more, then only a few car users, if any, will consider buying a gas-powered vehicle. Tesla is leading the pack on the price cuts, and it's hurting the other automakers even worse than it's hurting Tesla. The car company has pretty ambitious plans to ramp up production in Mexico. They have had the first mover advantage, and the deliveries today show that the price cuts are actually working. Price cuts in a hyper-competitive industry is generally bad news for everyone. Tesla is certainly feeling the impact from its own price cuts, and certainly other vendors are, and that's the dynamic that most investors worry about. In a really competitive industry where price matters, price cuts are detrimental to total industry profitability, and that is where most companies are starting to see, and this includes Tesla and other incumbents. Other OEMs are pretty deep-pocketed right now, and they are not transitioning to EVs fast enough. One reason, however, why the recent price cuts may be an issue is because Tesla is not really in the financing business, at least in places like Canada. And so all the loans are not held by Tesla, but rather by banks. Perhaps Tesla dropping prices could escalate the banking crisis even more, because if cars that are out there lose their value, then the bank's assets could also drop, and many may not be able to repay these loans because the loan is now bigger than how much the car is worth. At the moment, some Tesla investors worry that the Model 3 may lose $7,500 in tax credit, and others believe that there is a way for Tesla to still keep getting that tax credit, even though the Model 3 technically should not qualify. For instance, Tesla will be building a new battery factory in the US, in partnership with CATL. Some analysts believe that since the factory will be producing batteries in the US, Tesla can use this opportunity to its advantage, especially in terms of the tax credit. Tesla is looking to build a battery plant in the United States, in what would likely be a controversial arrangement with China's dominant electric vehicle manufacturer. The automaker discussed plans involving CATL with the White House, and it is considering building the battery plant in Texas to support its EV assembly plant there. Tesla plans to construct a plant wholly owned by the US automaker, and the car company will own and operate the factory while licensing the technology from CATL. Tesla wants to make lower-cost electric vehicles as a key part of its plan to fend off competitors. But to do this, the automaker needs to invest in low-cost, cutting-edge battery tech to see that vision through. A cheaper car would be an effective way to entice new customers to Tesla. While Tony perceived a demand problem for Tesla, it is still important to note that his predictions are for the short term, and these price targets do not really capture Tesla's worth in 5 or 10 years. Overall, he could be totally right here, but in the long term, Tesla's next-generation vehicle is going to outsell all of the competition by multiple times just with single models. Do you think Tesla has a demand problem? Let us know down below, and don't forget to tell us what your valuation of Tesla is. If you want to know more about what Tesla's been up to in the last few days, go ahead and click on this next video on your screen. See you there.